Good morning everyone. Once again, I'm Naveen Reddy, Relationship Manager Treasury from State Bank of India. I welcome Sri D. Ramesh Garu, AB Mishra sir, and special thanks to Kulkarni sir for organizing this event, and again a special thanks for all the audience to make it a large gathering here. Yeah, so before going into the presentation, I just want to show you an interesting snapshot on how the how the exports and imports scenario in the overall country and especially in the Telangana state. So if you can see in the slide on your left hand side, you see that the overall export scenario in the country is quite stagnant. If you see in the financial year 2024, it is somewhere around 770 billion. Compared to again in the financial year 2023, it was almost in the similar levels. But again, when you see the export figures in the Telangana state, you can see here almost a jump of around 25 to 30 percentage. So it clearly shows that the environment, especially the industry environment here in Telangana is quite positive compared to the overall country. At least the numbers say so here. During my conversation with various industry bodies, with various companies, primarily in the pharma sector, many of them are bullish in the next 2 to 3 years, especially the pharma sector. When I had a conversation with some of the big companies like Devisa, Laurus Labs, they have invested quite a lot in the last 2 to 3 years. In fact, many of them have they have a plans that increasing their capacity utilization to 50 to 60 percentage. And yeah, as again you can see here in the slides, it's no surprising that the drug and pharmaceutical industry, it is almost contributing 40 to 50 percentage of the overall merchandise exports in the Telangana sector. So I think I do believe that in the coming years, the percentage of drugs and pharmaceuticals is going to improve quite a bit, and I'm not sure whether that is good to the entire state or not, because I believe there is concentration risk when you're focusing too much on one industry. Again, even when you see the large, the overall exports, it is just happening in and around Hyderabad district, especially in the Rangareddy, Medchal, Malkajgiri, and Sangareddy districts. I think this is high time that the policy makers should seriously have a look, and they can diversify both the location and the sectors. I truly believe that. Now, just again going to the export finances, I just want to share you the overall picture of how the foreign exchange dynamics work. I just want to share you how a dealer sitting in State Bank of India, in the Central Treasury, how he looks the overall events and how he takes position in the market. Now, again, in the left hand side, in the top left hand side, you can see the overall inflows and outflows. It's no brainer that the exports and imports affect the overall exchange rates. But again, many of them, overlook the role played by the remittances. Now, if you again go back, the exports and imports overall, it is somewhere like $1.6 trillion. Again, the remittance, if you see the remittances, it is almost $130 billion. Now, India, as we know that, we are the largest recipient of remittances, almost double of what Mexico receives. Mexico is our second largest recipient of remittances. We are almost receiving double of what Mexico receives. Now, if you combine both and take out the percentage of the remittances that India receives, it is almost contributing to 1/12 of the overall the overall trade and remittances combined. So one cannot ignore the remittances part. Again, the investments and loans. Most of us, ignore this. We tend to overlook the investments and loans and how it actually affects the overall exchange rate mechanisms. Because it's not often that India receives a 1 billion or billions of dollars investments on every day. Exports and imports keep on happening almost on a day-to-day basis. But it is when India receives a substantial portion, let's say that Adani, it wants to raise 1 billion ECBs. So almost within a week or so, that 1 billion, it hits the market. Whenever it hits the market, I mean, you can see a sudden spike or sudden appreciation in the rupee. So one has to, I believe that one has to have a clear uh, uh, eagle's eye on what is happening. I mean, when it comes to the investments and loans portion. Again, recently, I mean, FPI and FDI flows, I mean, these are clearly making a wave. Uh, if you just pull out a graph and how the rupee is depreciating in the last 2 years compared to the outflows, the FPI and FDI outflows, you can see a similar graph. I mean, reflecting in both. In the last 2 years, I mean, you might have noticed that, I mean, rupee has depreciated around 2 to 2.5 percentage. Similarly, I mean, the FPI and FDI flows also, I mean, went out of the country. No, something I do believe that there is something happening in India which the FPS and FDI knows. It's not that, I mean, they have seen quite an interesting investment in other emerging economies. I don't buy completely that. Maybe something the policymakers, I mean, needs to address their issues. Again, IPOs, I mean, recently, I mean, with all the uh, uh, this new age technology companies, especially the Zomatos and Swiggy's coming into the IPOs market, and these companies, I mean, are quite a bit attracting all the foreign flows. So again, this is one of the factor that one needs to take in mind whenever, I mean, they're taking any position in the market. Specifically, I mean, whenever they want to go for export forwards or import forwards. And the other important factors that any exporter or importer needs to bear in mind is the price of commodities. As we all know that, I mean, we are primary importer of this crude oil. I mean, we almost import 87% of our needs. If you convert it into dollars, it is somewhere like 130 to 140 billion dollars. So as I said earlier, I mean, our total exports and imports combined is 1.6 trillion. So this itself is somewhere like 7 to 8%. So any spike in crude prices, so that again needs to taken care of whenever you are taking any positions. Not just that. Maybe you can see how the Chinese economy is performing, because China, as we know that, I mean, it's a huge it's a huge consumer of this commodity, especially the coal and the crude oil. So whenever you see that Chinese economy is slowing, you can simultaneously see that the commodity prices going off. I mean, it's cooling off. So that is again a little positive because. That again, as I said, primarily we are net importer of crude prices. So that is something positive for the INR. Again, actions of major central banks, it is one of the major factor that one needs to be taken care of whenever you are in exports or imports. If you can see in the last 2 years, from 2022 to 2025 till now, you can see how the US central bank, US Fed, how they have increased their interest rates. It's like 75 basis points and 75 basis points. So what happened is that in the last 2 to 3 years, the rupee has depreciated quite a bit. Because whenever an investor finds that US bonds are yielding a higher percentage, why will he wants to invest in emerging country with a lot of risks, want to invest his money in India and get returns like 7% or 7.5%? So something that, I mean, we need to take care of. Again, geopolitical conflicts, it's no brainer. Geopolitical conflicts, wherever it happens, it doesn't need that, I mean, it should happen in India only. In the last 4 or 5 years, I mean, we have all seen how the Russia-Ukraine conflict and the present ongoing Middle Eastern conflict, how it actually affected the exchange rates in India. If I remember correctly, those were the times that I've started my career in Treasury in the year 2020 to 23. So everything was calm and the rupee was trading somewhere like 75 to 78 levels. Suddenly this Russia-Ukraine conflict came, and just within a span of 1 week, the rupee has went from 78 to 82. So that is a volatility that one needs to take care of whenever you book forwards. I mean, it is you need to take care of your MTM losses too. I mean, whenever these black swan events happen, it clearly, I mean, affects your position. Again, the inflation, GDP growth, countries like India, we need to we need to manage our inflation in such a way that it doesn't run off. Because not many investors find comfortable investing in an economy where inflation is going out of bounds. So something that we need to take care of. Domestic factors. I mean, we keep on ignore the domestic factors. One is political stability. Let me tell you a quite an interesting story. You might have all seen the India's general election, which happened in last year in the month of June. So one interesting scenario has happened. If you are if you are in follower of stock markets or exchange rate markets, what you have observed is that after the last day of election, in the evening we do get these exit polls. So most of the exit polls, they were predicting that one major political party, it will get a landslide victory. So which is actually a benefit. People were assuming that it is pro industry and all stuff. So people next day, all the stock markets, it went up by 2 to 3%. Exchange rate, INR has appreciated by 1%, which is quite a bit thing. So everything was looking rosy. But on the election day, when the result came the otherwise, when people were expecting that it will get a comfortable majority in the parliament, but when it didn't happen, so what happened on that day is that stock market went down by 4 to 5%, and the currency has depreciated by 2 to 3%. So these are all the factors that one needs to take in care of when you are in exports and imports. And even now, after in the last 3 months, you might have seen how especially the news from United States after the new Trump administration took over office, how every day it's like an event of, especially in the exchange rate and the stock market. Again, fiscal policy and monetary policy and balance of payments. Thankfully, I believe that our policy makers and especially the central bank is doing quite a good work when it comes to managing the monetary policy, and even the central government also. It is strictly following the fiscal responsibility. Again, the participants, I just want to touch upon the regulators part, because most of us, ignore what a regulator can do it. See, regulator, the central bank is sitting with almost 650 billion worth of reserves. So whenever it wants to intervene in the market, it doesn't come with small chunks like 100 million or 50 million. It really disrupts the market. It comes like very recently, it came with a 10 billion swap. So imagine the average turnover in India when it comes to the exchange rate is like $20 billion. So imagine a 10 billion swap coming into the market, hitting in the market. How it actually affects the overall exchange rate, how it clearly disturbs the market is something that we need to be very watchful of. So as I said earlier, this is one of the key events that one needs to take care of when you are in exports and imports. As I said earlier, US Federal Reserve, it has raised from 0% to 5.5%. In the last few, their monetary policy meetings, they have decreased by half a basis points. But again, I believe in the last 50 to 60 years, it never happened that just within a span of 9 months, the interest rates shot up from 0 to 5.5%. Clearly, disturbing all the other currencies, all the major economies. And one key interesting thing is that whenever you are in exports and imports, especially the dealer who is sitting in a big bank central treasuries, he'll not just look into the US, the actions of not just the US. They will also look into what other central banks or what other major central banks were doing, especially the Bank of England, the European Central Bank, and the Bank of Japan. Again, one key interesting thing happened just 6 months back. Bank of Japan, we know that they're maintaining their interest rates, like they're for a very long time. Historically, they are maintaining negative interest rates because their country is in deflation, and they somehow want to come out of the deflation trend. So what happened is that after this Russia-Ukraine war and after this Middle Eastern war, their inflation has shot up. So in order to control their inflation, they have increased rates. So I think 4 or 5 months back, what they have done is that they have raised their interest rates from 0.1 to 0.25 percentage. So generally, what major corporates do is that they go for carry trade. So what is this carry trade? It's simple. They raise loans, they raise funds from Japanese banks, because Japanese banks, as you know that, they do offer, they do provide cheaper interest rates, and they do invest in higher yield currencies like US bonds or Indian, G6 or Indian treasury bills. Now, the logic here is that what they assume is that the difference between their, the interest rate differentials and the currency depreciation. So in that, they want to make money. So what happened here is that when the interest rate, when the Bank of Japan interest rate has increased, it actually appreciated their currencies. So most of their, most of them went into losses, and it actually created a ripple effect where people, where their stop losses got triggered, and it actually created a ripple effect. And even the Indian stock market also, it crashed like 2 to 3%. It's not a big crash, but again, it do affect the Indian markets too. Although it does not. We are not much connected to Japan, or after any to their banks. Again, from SBI, we do offer all these products. When you see in the forex market, we do provide the spot, forwards, crosses, derivatives, and swaps. So as you know that, SBI, it almost has a 20% of market share when it comes to dollar INR pair, and we are a significant player even when it comes to crosses, because we are present in 40 to 45 countries with almost more than 230 foreign representative branches. So we do have significant presence when it comes to other currencies too. Again, in trade credit, we do offer PCFC, export packing credits, EBR bill discounting, buyers credit, suppliers credit. In the money market products, we are like the big boy in the market. We have quite a substantial investments in commercial papers, non-convertible debentures, overnight index swaps, G6 and treasury bills. And even in the other financing also, we are a primary player when it comes to external commercial borrowing, CCBs, and FCNR demand loans and term loans. I'll explain these products in my later slides. Now, if one thing, if you can ask whether going for hedging is either it is a beneficial or not, so there is no one right answer. Now, if you see that, one might argue that, see, my business is completely different. I don't want to take any position. I don't want to keep my position open to exchange rate risk. Then maybe in your scenario, it is better to go with hedging. But if somebody wants benefit from the exchange rate movements also, maybe for them to keep their positions open might be a good idea. So how can you go, if you want to do a hedging, what are all the products that you have in the market? Again, you have options, you have forwards, again, you have swaps. So all different products, which will help you in mitigating your various kinds of risks. In the forward market, we have forwards in the dollar INR pair and even in the cross currency pair also. Again, in the options, we do offer plain vanilla puts, calls, and cost reduction structures too. Again, if you want to go for exotic structures, we have this POS, principal only swap, interest rate swap, coupon only swap, and the CIRS. Again, export finance pre-shipment. I just don't want to discuss in detail about these products. One thing that I want to explain to you, which is very much, it might be helpful for you, is that whenever you avail this EPC in rupee, I believe that you can actually you can actually go for your export receivables forwards, because what is happening is that, let's say that your EPC interest rate is somewhere like 7.5 or 7.6%. If you go for a export forward, that itself will give a yield of 2.5 to 3%. Now your net interest rate will substantially come down to below 5%. So something that you can take advantage of. Again, the disclaimer that I think it actually only works when there is relatively calm in the market, when the volatility is a little low. Maybe in that time, you can go with these strategies. Again, in the PCFC, again, you can take, when you know that you will be availing PCFC in the next 3 months or 4 months, it is better that you hedge your PCFC disbursements, because you know that you will be availing PCFC after 3 months or after 4 months, and you also know that you will use that PCFC in your domestic operations. So for that, you need to convert your your dollars or in your euros or Great Britain pounds. So you know that you want to convert that into INR. So better strategy is that why not you take a forward, so that at least you will be benefiting with that forward premium. Again, all this comes with a disclaimer. Whenever there is relatively calm in the market, you can go with these strategies. Because when there is too much volatility, like what is happening in the last 2 to 3 months, I believe it's better to keep your position open than going with a hedging. Again, in the post shipment, we do provide this negotiation or purchase discounting in rupee and export bill rediscounting. Again, as I said earlier, when you know that you have to pay your INR liabilities, it is better to hedge that liability, because your receivables will be in dollar and and your liabilities in INR. So better you hedge your receivables. So that will be a great strategy to implement in your companies. Again, ECBs, we are a primary player in ECBs. As I said earlier, we are present across 29 to 30 countries with a 230 to 240 foreign offices. So we do provide ECBs facility. You can avail through our bank, or if you have availed in other banks and want to hedge your ECB liabilities, and that also we do. This is quite a popular product when in the larger corporates. Even if your firm is more than 100 crores and has an external rating of AA and above, maybe you can explore going through ECBs also. Other popular product, that is quite a bit doing rounds, is the FCNRB term loans and demand loans. So the beauty of this product is that you don't need to be an exporter or an importer to avail this facility, because even a company which is purely into domestic also, they can avail this FCNRB facility. But again, with hedging, if you are into exports, then there is no need for hedging, because you have a natural export proceeds. So there is no need for you to go with hedging. But if you are primarily into domestic market, if you are primarily into domestic sales, then it is better. It is actually compulsory for you to hedge your liabilities. So at present, as you can see, the 6 months so far, it is at 4.2%. And let's say that your spread is somewhere like 2 or 2.5%, and the forward premium right now which is trading in the market is again 2.5%. So overall, if you combine, maybe you can reduce your liability, your INR liability, to less than 9% or even better than that. So again, you can explore these products. But again, the thing is that getting funds is a little bit difficult, because again, FCNRB loans we can give only on FCNRB deposits. So before taking FCNRB loans, I request your relatives or your friends to make deposits in SBI in foreign currency. So again, other beautiful product that not just SBI, all over banks that are offering is the FX retail product, which is actually developed by CCL, Clearing Corporation of India Limited, and which is regulated by RBI. This is actually an RBI product. The beauty of this product is that when you are a small time trader, you generally don't get the interbank rates. The dealer, because you will be dealing with a 250,000 or less than 250,000. But for an interbank dealer, to cover that, he needs to wait till his position goes to 1 million. So in order to avoid this, in order to give better rates to even smaller players also, what RBI has implemented is FX retail platform. So here is that whatever SBI is getting rates in the interbank, you can also avail that rate through FX retail platform. Again, the minimum transaction that you can do here is $1. So that is again very much beneficial. Maybe if you're an exporter or importer, you can explore this platform. So it is simple documentation, nothing much is required. Just an application and then stamped indemnity. Within just 1 or 2 days, your credentials will be given and you can use this facility. So as I said, we are from a treasury team. Our team sits at SBI LHO office. So maybe, I mean, if you're an exporter or an importer, anytime, I mean, you can get in touch with us. We'll distribute our cards to you. So yeah, so that's our presentation. So thank you so much. Thank you, Kulikarni sir, for doing this.